speaker is leading expert in financial rating and Islamic finance. Please welcome Dr. Mohammed Damak, Managing Director and Sector Lead for Financial Institution at S&P Global Ratings Protocol. A topic that's Dr. Damak will be sharing his insight on S&P Global Rating, credit approach to Sky and decentralized lending. Let's give a warm welcome to Dr. Mohammed Damak.
Thank you very much. Good morning to all of you. Last year I was on this stage and I was talking to you about our stablecoin stability assessment, which is an assessment that S&P Global Rating created to cater for a specific need in DeFi, which is the risk that stablecoin depeg from the parity. This year I'm going to talk to you about something equally exciting, which is how we rated the Sky protocol, which is the first DeFi rating that S&P Global Rating has conducted. But before doing that, how many of you are familiar with the Sky protocol? Can you raise your hand if you're familiar with Sky protocol? It's the previous maker DAO that prints the DAI stablecoin that was renamed USDS. No, you're not familiar. Okay, excellent. So basically, Sky protocol is a lending protocol whereby if I'm a holder of a cryptocurrency and don't want to sell it because I'm expecting the price to appreciate, I can bring it to the Sky protocol and take a loan against that crypto using certain number of characteristics. Now, we have a stablecoin stability assessment on DAI, which is the stablecoin that is issued by Sky protocol. But this year, we've assigned a rating to the Sky protocol itself. And the difference between stablecoin stability assessment and ratings is that stablecoin stability assessment allows to compare stablecoins among themselves and speaks to the risk of depeg, while a credit rating speaks to the risk of default. And obviously, as credit analysts, the first thing that we do when we're asked to rate an entity is we look at the financial statements that are published. Here, there's no financial statements that are published, but there's better. I mean, all the information are available real time on the blockchain. And here you can see a schematic of the balance sheet of the protocol. So on the liability side, you have the stablecoin printed by the protocol. These are the stablecoins that you would get each time you would bring your assets and take a collateralized loan against the assets. They have an equity buffer, which is there to absorb the unexpected losses. And on the asset side of the balance sheet, they have a cash reserve and tokenized money market funds that are held as liquid assets. And by looking at this balance sheet, it sounded very similar to what we see in the traditional finance world, and specifically for non-bank financial institutions or even for banks themselves. Banks take deposits on the liability side and issue loans on the asset side. They maintain liquid assets in order to be able to face withdrawal whenever they come. And they have an equity buffer that is typically decided by the regulation, the prudential regulations that asks bank to set aside capital in order to cover unexpected loss. So the starting point was that given the similarity with financial institutions, we may want to start with the financial institution methodology. But then the next challenge that we face is how do we define default? In the traditional finance world, if you're a corporate or if you're a bank, you issue a bond or you issue an instrument on the international capital market. If you don't pay on time, that is a default. If you're a DeFi protocol, the story is different in a sense that you would default, and from our perspective, either if you make your depositors absorb a certain portion of the losses, meaning that your losses on the asset side of the balance sheet have depleted completely your capital buffer so that you are in the obligation of sharing those losses with your depositors. Or the other alternative is you deplete your liquidity buffer so that whenever a depositor comes and asks for the money back, they don't get it and they get to a position where the liquidity buffer is completely depleted. And in order to capture the risk, or in order to change the rating to default, there's two scenarios that we have rated to. The first one is a complete depletion of the capital buffer. And in this case, in our rating criteria, we have a specific criteria called the CCC criteria that we use whenever we think that default is becoming a plausible scenario. And the second possibility of default is a complete depletion of the liquid buffer, so that when the depositors come and ask for the money back, they don't find any liquidity left in the protocol. The other challenge we faced when we started this rating exercise is when we rate entities in the traditional finance world, we rate legal entities. We rate corporates, we rate banks, we rate insurance companies, but all these are legal entities and have a legal existence. In securitization, we rate the SPV and all the contractual arrangements that are around that SPV. Here, Sky Protocol is a smart contract, and it's a piece of code, but Sky Protocol is also a certain number of governance arrangements that are turning around this smart contract. And that's why, in order to derive the rating, we decided to focus not only on the smart contract itself, but also on the different participants that contribute to the governance of the protocol. The fact that it is not subject to a regulation, and also Sky Protocol has a decentralized governance structure. So there, in our assessment of business position, we looked at similar factors that we use for the rating of banks, but also we added additional risk that are incurred by the protocol. For the capital and earning and risk position, the analysis was very similar to what we do for banks. So typically for capital and earning, we calculated a risk-adjusted capital ratio to assess the sufficiency of the capital resources of the protocol to face unexpected losses. And for risk position, we looked at any other risks that the protocol could incur beyond what is factored into our capital analysis, such as concentration risk, for example. We came up with an overall rating at B- stable. Here you can see how the methodology incorporates additional notches or deduct notches in order to reflect the risks that are incurred by the protocol versus the anchor. We came with a B- rating. A B- rating is at the lower end of the rating scale, but it helps to put the protocol on the global map of the fixed income instruments. A B- rating for Sky Protocol is compared to a B- rating that we would assign to a bank, or that we would assign to a sovereign or a corporate. Ratings comes with outlook, whereby we as analysts try to come up with potential scenarios that could lead to a rating upgrade or rating downgrade down the road. For Sky Protocol to be downgraded, obviously liquidity is one of the important considerations that we look at. And here, if we start to see a depletion of the liquidity buffer of the protocol, particularly in the PEG stability module, and a depletion of the stable coins in the PEG stability module, that could have a negative influence on the rating of the protocol. Capital is the other factor that could drive the rating down. So for example, if we start to see significant losses on the cryptocurrency-backed loans of the protocol beyond the capital buffer of the protocol itself. And finally, Regulatory development could be disruptive for the Sky business model. As you know, the decentralized stablecoin issuers are out of the scope of the Genius regulation in the US, but if tomorrow we start to see disruptive regulation, this could disrupt the business model of the protocol. On the upside scenario, better governance, particularly the still concentrated decision-making related to the protocol. Also, what could drive the rating up is a stronger capital buffer, so more capital as rating agency will of capital. And finally, what could drive the rating up is a reduction of the deposit concentration on the liability side, because deposit concentration could lead to liquidity pressure if we were to see significant withdrawal. That was it. Thank you very much for your attention. I think we have, can we take a question? Can we take question from the audience? Yeah.
Je suis Gustavo Montero, le founder of Carter Capital. Mohammed, fantastic. I love what you're doing. I come from the times of Gap, right? X-Prize Waterhouse. So I suggest that we now do the CAP as crypto accepted accounting standards. We can do it together, because I've been looking for this for years. But I want to ask you a technical question. Can you go back to the balance sheet that you have at the beginning?
Can
the very first slide you had?
Yeah, can the organizers put back the slides?
If not, it doesn't really matter. I'm just not going to ask you a question.
All right.
Right, okay, so on the liability side, I'm also an ex-banker, so on the liability side, the USDS stablecoin, how does it come there? Who issues it? How is it lent to the party? Because it's key to understand the rest.
Absolutely, and thank you very much for the question. So the way it works is, let's say you have 100 Bitcoins and that you don't want to sell them because you expect the price of Bitcoin to appreciate. What Sky protocols offer you is the capacity to take a loan using those Bitcoins as collateral. Obviously, the parameters of the loan in terms of loan to value and liquidation would be decided by the protocol, but instead of selling your Bitcoins, you can borrow against them. Let's say you borrow for the equivalent of the price of 80 Bitcoins or 70 Bitcoins, but the loan that you will be taking is denominated in USDS, which is the stable coin that the Sky protocol issues. In the past, yes. In the past, it used to be named DAI when the protocol was named MakerDAO, but then they've renamed the whole protocol and the stable coin last year, and it became USDS stablecoin. The stablecoin is backed by the assets of the protocol. So in each vault, so let's say your vault would be a loan that is backed by Bitcoin with an LTV of 70%. My vault would be a loan that would be backed by ETH with a loan to value of 65%. Another vault would be a vault of real world assets that would be backed with a certain parameters. And the way it works is that you could use your USDS or your DAI, you can transact on chain, you can place it, you can buy other Bitcoins, you can do whatever you want. But when your loan comes to maturity, you'll have to repay it, otherwise your vault will be liquidated. And the risk is that if there's a massive drop of the prices of Bitcoin or ETH or real world assets, is that losses starts to accumulate here on these different loans, so that it depletes completely the equity buffer. And if it depletes completely the equity buffer, it means that the protocol will have to ask the different stablecoin holders to absorb a portion of the loss. Yes. Yes, and they have some vaults with real world assets that are less liquid than a tokenized market fund, or that are less liquid than the ETH or the Bitcoin or the other cryptocurrencies. And there it will have different parameters in terms of loan to value, but also threshold to liquidation. So if your vault hits the threshold, then it would be automatically liquidated so that it can protect the overall protocol. In this case, typically, if the equity buffer is completely depleted, then there is an emergency shutdown mechanism by which the protocol would decide what sort of losses would be absorbed by which vault owners. Thank you.
Thank you, Dr. Mohammed. Now we will go for the roundtable session for the future of tokenization, financial instruments, potential challenges, and repetition. Moderating the session is Gustavo Montero, founder of chairman of the Character Capital, and the session includes Arish Goel, advisor at Chain Analysis, Cinderella Amer, partner at Vizor, Dr. Mohammed Damak, managing director and sector lead financial and global head of Islamic finance, Dolly Ramaya, founder and MD at Trillium Studio. Let's welcome them on stage.
I'll sit a bit like this so that I can see you. That's right, no, sit on the spine.